Back when I started investing in the stock market, like with most new investors, there were quite a few concepts that I had a hard time wrapping my head around and that were just plain confusing, specifically relating to the TFSA, day trading rules, as well as overall portfolio strategy. But now that I have years of experience investing in the stock market and sharing my knowledge on this YouTube channel, I decided that I would compile a variety of these different topics that audience members had expressed confusion on into what is part 1 today of a series of videos that I'll be releasing on the channel relating to common tips as well as mistakes to avoid. Hey, what's going on everyone? It's Griffin here and I hope you're having a great day as always. If you're new here, then welcome. On this channel, we speak about all things investing from stock market news, company analysis, real estate, and then overall investing topics like in today's video. So if you're looking to expand your knowledge and grow your wealth through investing, then make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release upcoming content. Now in today's video, we're going to be taking a step back from all of the specific company analysis and telemedicine content that I've been releasing on the channel in order to circle back to some fundamental concepts that are really important for all retail investors to properly understand. I used to make videos like this on the channel all the time, but with so much market specific content lately, I thought it would be productive to sprinkle in a video here and there about some common tips and mistakes to avoid in the market that I honestly wish I would have known when starting out years back, and that still to this day I know a lot of retail investors, whether new or even seasoned, can still be confused on. So these are going to be tips and mistakes that have been asked by audience members on the channel over the past couple of months, and I'm going to be compiling 4 of them today into today's video, and then moving forward in the next coming weeks and months, I'll be releasing more parts to this series with new tips and questions that people have been asking down in the comments. Now, the information in today's video is not in any particular order or whatnot, so we're just going to be going through them one by one, and hopefully you'll find value in this video. If you do, please take 2 seconds to smash the like button. It really helps my channel out. And on that note, let's get right into it. Oh, and before I forget, if you still have to open your very own brokerage account to start investing and trading stocks, then make sure to check out the 2 links down in the description to open up either a Questrade or a Wealthsimple Trade account, and you'll get some free money for opening an account and funding it. Alright, so the first common tip and somewhat mistake that a lot of new investors aren't necessarily aware of when starting to invest in a TFSA, that is a tax-free savings account, is how contribution room can be gained and how it can be lost. I've already released a couple videos on the channel speaking about how the TFSA works in general as an investment account and how contribution room is cumulative from the year that you turn 18 years old. So I'm not going to recap all of that information. If you need to get back up to speed on all of that, make sure to check out one of my TFSA related videos. But even with those videos, there seems to be some general confusion from the audience as to how contribution room can actually be permanently gained and permanently lost depending on the investments in your account and how they perform over time. This is a topic that is definitely confusing because you would think that the CRA would allow you to contribute up to your cumulative contribution room. For example, if you were 18 or older from the year of 2009, you would have a total cumulative contribution room of 69,500, and that would be it. You would be capped at that contribution room. So this part of it is actually quite straightforward. As an individual, you can contribute funds from your own pocket or other savings accounts to your TFSA up to $69,500 in contribution room from your own pocket if you were 18 years or older from the inception year of the TFSA, which was 2009. And then from there, the value of your total contributions can then grow over time tax-free or even lose money depending on the investments that you make within your TFSA. Hopefully you've been watching my channel for the past couple of months and have been able to materialize some serious gains in your TFSA, all tax-free. But in summary, this is essentially how the TFSA works and what most individuals know of it. Here's the thing though, the value of your investments held within your TFSA can obviously exceed your total contributions, which I would hope so because that's the whole goal of investing in the first place, is to make nice returns on your investment. But once this happens, your total contribution room actually grows and expands with the overall value of your investment portfolio also. And the same is actually true relating to the value of your TFSA declining from the total value of your contribution rooms. You can actually lose overall contribution depending on how you go about withdrawing your funds after an investment has either performed poorly or negatively. This is a concept that I've had quite a few viewers ask me in my day trading in a TFSA video, where the concept of losing or gaining contribution room permanently was somewhat confusing, so let's dig into that right now. Without getting too technical, the the formula for calculating contribution room is as follows. We start with your previous total contribution room and then add to that the new contribution for the upcoming calendar year, and then also we need to add the previous year's withdrawals from your TFSA, which in total is going to give us our total contribution room of the TFSA. So to summarize, it goes like this: old room plus new room plus previous year's withdrawals equals total TFSA room, right? So the old room is quite simple. This is the total cumulative contribution room that you had in your TFSA previously, and then add to that this year's upcoming contribution room allowed by the government, most likely $6,000 when you're watching this video. Things can now get a little bit more complicated when speaking about the previous year's TFSA withdrawals, in that if you withdraw more than your total allotted contribution room from the government in a previous year, well, when you go back to invest in your TFSA, you can contribute from your own pocket all the way back up to the total value of your TFSA when you withdrew those funds. You don't need to only contribute up to your government issued contribution room. So this is where it can get a little bit confusing. Let's actually take a look at a couple examples here to better illustrate my point. If you turned 18 3 years ago and haven't ever contributed to your TFSA, well, you would have a cumulative contribution room of $16,500 as your old room. Then the next year, you would have another $6,000 if that's what the government decides for 2021, for a total contribution room of $22,500. Now, if you go ahead and contribute this total amount into a stock that absolutely tanks, let's say, the company goes bankrupt and you lose all your funds and sell the positions at a huge loss, well, the following year, you're only going to be able to contribute the new amount that the government has allowed. You can't just go back and recontribute another $16,500 that you previously lost, because the government sees this as already contributed funds. In this case, unfortunately, you would have permanently lost out on your cumulative contribution room if you would have indeed sold at that massive loss. Now, if you chose not to sell the positions at a massive loss, though, that was significantly under the value of your actual contributions, and you held on until it inched back up into the green, for example, well, in this case, it's only when you actually materialize a loss that you lose that contribution room. I really hope that this makes sense, and it's one of the reasons why I preach over and over on my channel that even in a tax-free savings account, yes, the value grows tax-free, but it's really important to still treat this account with an overall strategy where you're utilizing ETFs to build a foundational layer and then going ahead and hand selecting stocks that will be able to potentially create some nicer returns that'll potentially beat the market. On the flip side of that same example, if you contributed that total $22,500 and the value went up to $50,000 in 1 year, at which time you decided to sell all the assets, well, the next year you can actually go back and recontribute $50,000 plus the new $6,000 in allowed contribution. So this is the reason why contribution can actually be gained or lost within a TFSA. I really hope that this makes sense, and if you have any further questions, make sure to drop them down in the comment section. Let's now dive into the second topic for today's video, which is more of a tip relating to US withholding taxes on dividends within the TFSA. If you're enjoying this video up to now, please take 2 seconds to drop a like on it. Now, again, I've spoken about foreign withholding taxes relating to US dividends in a full comprehensive video on my channel, but even still, I see individuals in various different investing groups on Facebook mention foreign withholding taxes as being something that they try to avoid, or at the very least don't fully comprehend, specifically relating to the TFSA. This is because the TFSA is supposed to be tax-free, which it is for everything except foreign issued dividends, specifically a 15% withholding taxes on US issued dividends, and this is already withdrawn from the issued out dividend before it even hits your account. Essentially, if you hold US stocks in a TFSA or a Canadian cash account, you're going to be subject to that 15% withholding tax on the US issued dividends. The only time that this is not the case is if you hold US stocks in an RRSP. If the dividends would have been issued from a Canadian company that you're holding in your TFSA, then no, you would not be taxed on those dividends. Now, where I see people getting hung up on this is avoiding and not wanting to pay that 15% dividend withholding taxes on the dividends exclusively, and for this reason, they will avoid holding US stocks or ETFs that hold US stocks in their TFSA account. I honestly see this as being a huge mistake. First, from the standpoint of the fact that in the big picture, 15% withholding tax on the dividends exclusively is really not a big deal. And then on top of that, spending extended time thinking about this at all instead of taking that time to research further opportunities, this is where I think people are making a mistake. The reality is that the US stock market is arguably the best stock market in the world, and not being a part of it just because you don't want to pay 15% withholding tax on the dividends alone is a huge mistake in my opinion. For example, let's say you invested $1,000 into Apple on January 1st. Well, as of today, this would have a value of roughly $1,650, which if invested in a TFSA, you could then sell completely tax-free. Now, the dividend you would have incurred on that $1,000 invested for the 3 first quarters of the year would be roughly $50. And of that, $7.50 would be withheld in withholding taxes. So I think that with this example, you're sort of catching my drift here, that paying $7.50 in withholding taxes and still getting roughly $43 in dividends that are tax-free, and then also taking advantage of that $650 in appreciation, once again tax-free, is definitely worth paying that $7.50. The main priority when researching new investments and stocks to add to your portfolio is whether or not this is a company that's going to be able to provide nice returns for you and fit within your overall investment strategy. If you are interested in learning more about withholding taxes for each individual investment account available in Canada though, I would recommend that you check out this video that I'm overlaying right here. The third tip that we'll be speaking about today is somewhat related to the first one in that you can't actually claim a capital loss in a TFSA, unlike in a cash or a margin account. So not only can you permanently lose contribution room in your TFSA if you do end up selling at a loss, but this loss cannot be claimed as a capital loss at the end of the year on your tax return. And by the way, if you're not sure what a capital loss even is, it's essentially a deduction for the total value of your loss during that calendar year in your investment that you're able to deduct from your overall taxable income at the end of the year on your tax return. For example, if you put $6,000 into your cash investment account and then you end up losing $3,000 on a bad investment, well, you can actually deduct $3,000 from your total taxable income at the end of the year, thus lowering your overall taxes to be paid. In the case of a TFSA though, let's say you turned 18 this year and you contributed the total of $6,000 that you're allowed to contribute, and then you made a bad investment losing $3,000, and for some reason you decided to sell at a $3,000 loss. Well, not only have you lost that $3,000 in contribution room, but you're also not even able to claim that $3,000 loss as a capital loss on your tax return. This is definitely something that you're going to want to consider when looking to include very high risk positions into your TFSA, and is one of the main reasons why I recommend that for high risk positions, you allocate a smaller portion in your TFSA. As always, proper due diligence is always necessary when looking to include a certain company in your overall investment portfolio, but even further for your TFSA. The next topic that I'd like to bring up here is not necessarily a tip per se, but it's something that I've been asked previously on the channel, and I actually didn't even know the answer myself, so I did some further research and digging and came up with the answer to whether or not all stocks in general are eligible to be in a TFSA. This is somewhat of a strange question because you would think that pretty much all stocks are eligible to be held within a TFSA, but in reality, the stocks that you hold in a TFSA or the funds need to be listed on what's known as a designated exchange. Now, for all the stocks and other companies that we speak about on the channel, you're going to be completely fine here because these are all stocks that are listed on what's known as a designated exchange, but I thought it was still worth mentioning since some individuals had asked me, and for if you're looking to include some higher risk and unknown positions in your TFSA. I'm not going to go through all the criteria that an exchange has to adhere by in order to be considered a designated exchange. But if you want to read more into that, I'll leave a link down below. But all the stocks that trade on the exchanges that are scrolling through right now are eligible to be held in a TFSA. Essentially, the CRA just wants Canadian investors to be holding legitimate assets in their TFSAs, which isn't a bad idea anyways. Alright, so this pretty well wraps up the part 1 video of the investing tips and mistakes to avoid series. I really hope you enjoyed it. If you did, please make sure to smash the like button. It really helps my channel out. And make sure to let me know down in the comments whether or not you did indeed enjoy this type of content and would like to see more videos in this series. And if you want to learn more about investing in the stock market and investing in general, then make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. There's many companies that I've spoken about previously on the channel, such as Lightspeed, RioCan, and others that are going to be releasing their upcoming earnings, so make sure to stay tuned for those analysis videos. On that note, thanks a lot for watching today's video, and I'll see you in the next one.